Hello, America and the world. This is Radio Free Market, and I'm your guest host, Aaron Brown, sitting in today for Michael McKay. We are behind the lines of socialism, my friends, and Radio Free Market is the voice of free people and free markets. Our topic today is who correctly explains the boom and bust business cycle, Robert Murphy for the Austrians or Paul Krugman for the Keynesians, and why everyone should care. First, we want to welcome our special guest, Dr. Robert Murphy. Hello, Dr. Murphy.
Hi, Aaron. Thanks for having me.
Yeah, glad to have you here. Bob is an adjunct scholar of the Mises Institute and a faculty member of the Mises University. He runs a blog called Free Advice at consultingby.rpm.com and has authored several great books, including The Politically Incorrect Guide to Capitalism, which was my introduction to Austrian economics. So what I want our listeners to get out of this show is whether it is the Keynesians or the Austrians who are correct on why we have this boom-bust cycle, and we want to give an overview of the Keynesian versus the Austrian views and how to cure the boom-bust cycle. So you recently challenged Paul Krugman, who is a Nobel laureate, New York Times columnist, and a professor at Princeton, to debate this topic publicly. So please tell us why you initiated this challenge and the details about the debate.
Well, sure. So as we're going to get into in this interview, there is this huge difference in perspective among what's called the Austrian economists on the one hand and the Keynesian economists on the other. And because of their different diagnoses of what causes the typical boom-bust cycle in market economies, they come up with radically different prescriptions. So the Austrians are going to say that the government needs to get out of the way and that the Federal Reserve doesn't want to be pushing interest rates artificially low to try to re-stimulate the boom. And the Keynesians are going to say the opposite, that in a recession period that the Federal Reserve ought to push interest rates really down to try to get people to spend more, and that the government needs to pick up the slack and run huge deficits to try to boost total spending. Okay, so they're completely different views of why recessions happen and then what the proper policy responses should be. And Paul Krugman is, I think it's fair to say, is the world's most popular Keynesian apologist, if you will, that he's the one who's coming up with all sorts of economic arguments for why Keynesian policies are a good idea. And he's also very prominent in the public sphere, that he's on the weekly talk shows on Sundays. He has a blog at the New York Times and so forth. So that's why he's really a good public figure representing Keynesianism to debate. So what I did is I challenged him to a debate. Lots of people have done that over the years, and he hasn't done it because in his mind, he's above it all, and he's not going to waste his time with these Austrian economists. So the little twist on my debate proposal was I set up this campaign where people can pledge money who want to see the debate happen. But the trick is the money only gets donated if Krugman actually debates me, right? So there's no commitment for people who make pledges. If Krugman never actually debates me, nothing happens. Mm-hmm. But if he does debate me, then their credit card gets dinged. And the other thing is that the pledge total goes to a food bank in New York City. So as of right now, we've raised about, $65,000 or $70,000 that will go to this food bank in New York City where Krugman lives if he ends up debating me. So the idea is to bring some pressure on him to say, hey, why don't you debate this guy Murphy? And if people want to see more about that, I have a website, KrugmanDebate.com, where we've got all that stuff laid out.
Mm-hmm. Now it's been a few months since you've challenged him. Has there been any response from him at all?
Well, no response as far as the debate per se. I mean, CNBC, one of their guys, John Carney, did a story on it when it was 2 weeks old, and commented or solicited a response from Paul Krugman, who didn't answer the email. So, and I know people who think it's funny and like my campaign, they occasionally put stuff in the comments at Krugman's blog. Whenever something comes up about the Austrians, they'll put something. They're like, "Hey, why don't you debate this guy Bob Murphy?"
Okay, Bob, I've got to interrupt you real quick. We're coming close to the end of our first segment, so Stay with us. We are going to be back with Bob Murphy talking about Austrian business cycle theory and his debate with Paul Krugman. Stay with us. Hello, Hello, America. We're back on RadioFreeMarket.com. We are talking with Dr. Robert Murphy, and we left off. I wanted to let our listeners know, if you want to keep tabs on how the progress is going with his debate with Paul Krugman, check out KrugmanDebate.com. And I think it's just a great way to get these ideas out in the public. And one thing I want our listeners to know is that Bob, although an Austrian economist, has had a full mainstream Keynesian education, if you will, at NYU. So he knows both sides of the debate very well. And you gave one speech in particular about the topic that I thought was fantastic, where you broke the definition down word by word, because it sounds kind of complicated, Austrian business cycle theory. So could you just break that down, word by word, what Austrian business cycle theory means?
Well, sure. So we should probably back up a step and just realize what's the Austrian school. What is that? So that's, there's the Chicago School of Economics, the Keynesian school, things like that, and there's the Austrian school, and that's just named after economists who historically tended to come from Austria. That's where the name comes from. But nowadays, just the name's stuck, and it's mostly Americans that's like the center of Austrian economics right now. Places like the Mises Institute in Auburn, Alabama, named after Ludwig von Mises, who was a famous Austrian. And probably the most famous name that listeners will have heard of is Friedrich Hayek, who was the 1974 Nobel Prize winner in economics. He was a famous Austrian economist. So their theory of the business cycle, as developed by Mises and Hayek in particular, is that in a market economy, the booms and the busts that we regularly experience, that's not something that's normal to capitalism, right? Because even a lot of free market people tend to think that the business cycle is just, sometimes there's upswings and there's lots of prosperity, and then sometimes there's downswings, and that's, you have high unemployment, and that's just the way the world is. But no, the Austrians say those things are due to government intervention. And specifically, it's when the central bank, which is the Federal Reserve in the United States, when it has an easy money policy or an easy credit policy and floods the financial sector with new money, that pushes down interest rates. And those low interest... I'm
going to try and... We're going to get into that, but I just want to let our listeners know what Bob is trying to say, that the Austrian business cycle theory is an attempt to explain why the economy grows and we seem to have this apparent prosperity, and everyone's spending money, and then all of a sudden, boom, everything comes down very quickly. And you were given the Austrian side, and I wanted to start off with the Keynesian, a little bit of the Keynesian explanation, if you would, Bob, just so we can be fair to both sides of the debate.
Okay.
So, could you tell us what the Keynesian version of this business cycle, this boom and bust phenomenon is? What are the Keynesian? What is their explanation?
Well, sure. So the Keynesian view. The central insight for the Keynesians is that one person's spending translates into somebody else's income, and so that it's wrong that in a recessionary period when things are starting to look bleak for some reason, whether it's because of the housing bubble bursting or there's some crisis or something, but for whatever reason, if people start getting skittish and consumers don't want to spend money, they start hoarding money, meaning they spend less to try to build up their cash reserves. If business people get nervous and they start investing less, things like that, because everyone wants to just do this smart thing in their own little narrow perspective, the Keynesians will say, well, in the aggregate, if everybody's doing that at the same time, well, then everyone's income is going to drop. And so paradoxically, the Keynesians say, if everyone tries to save more and to sort of become, more liquid and to build up their wealth, they're actually going to impoverish the whole nation. Because when you stop spending to try to build up your own cash reserves, well, then other people that used to go out to eat at their restaurants, or if you went to buy something at their electronics store, now those businesses see their sales plummet. And so then they in turn cut back, they might lay off workers and so forth, and so they spend less, and it's just this vicious downward spiral. So in the Keynesian view, the way you get out of a recession is you need someone to step up to the plate and spend more. And that they say the obvious candidate to do that is the government, that the government comes in and just starts spending more money, and it really doesn't even matter what they spend it on, just to get total spending up to then raise incomes back up and fill that gap. So that's what the Keynesian explanation is.
So Keynesians see that saving is bad and that spending somehow primes the pump and gets the economy going again. So, Bob, I've read Murray Rothbard, and he says that, if you have a theory of the business cycle, you have to explain why all these businesses, all these entrepreneurs, they fail all at the same time. That for some reason, all these entrepreneurs who are selected by the market to be good business people do incredibly stupid things all at the same time. Do the Keynesians have any sort of explanation for that?
You're right. You raised a good point. That just to repeat it, Rothbard says that one of the key things about the business cycle is that in a normal economy, on any given day, some firms are going to have bad times. At any given month, you're going to have some firms going out of business and other ones starting, and that's just normal. But what it is about a business cycle, once the boom turns into a bust, or what we call a recession, the idea is that there's this general bad business going on, that lots of places are laying off workers. Various industries are all shrinking. And so that's what Rothbard was trying to say, is why is it that it seems across the whole country, all these various businesses and different industries seem to have made bad mistakes that now require them to lay people off because they're trying to correct for those errors. And so the Keynesian view, well, I think what they would say is that it's not so much that they made mistakes. They're going to say the reason all these businesses are contracting is this self-reinforcing cycle, or the snowball effect, that if there's some disturbance for whatever reason that gets people a little bit skittish, then it just feeds upon itself, and so people stop spending as much, and then all the businesses have less income, so they cut back, and then it just keeps reinforcing itself. So it's, in the Keynesian view, there's not this cluster of errors or mistakes that they need to explain. It's just, no, these businesses were fine. They would be healthy if people were spending more, but the people aren't spending more for some reason, and so that's not why these businesses are now all in trouble. Whereas in the Austrian view, the business owners made actual mistakes during the boom period. They invested in things they shouldn't have, and that's now why they're in trouble, because they actually did something wrong. Whereas in the Keynesian view, they're going to say, no, right now, there's nothing wrong with the structure of the economy. Our capacity is still there. It's just people aren't spending enough to use all the resources that are laying idle.
Mm-hmm. It's just, and we wanted to give this side of the debate. We wanted to make sure that people kind of understood it. It just sounds crazy, but we wanted to give it its time anyway. Is there any merit to the Keynesian explanation of the business cycle, or does it describe symptoms instead of root causes? It seems I'm having trouble finding an explanation for really the root cause. As you say, it's just kind of, there is this disturbance, and then the Keynesians kind of try to explain away what happened. Do they explain, try to get to the root cause? Do they have a root cause for the business cycle?
Well, I know, I think that the root cause would be different from cycle to cycle, because, again, the general Keynesian story is, for some reason, people stop spending as much, and then that's what starts the snowball down the hill. So for this particular recession, I think somebody like Paul Krugman is going to say, we had irresponsible deregulation that occurred, in the late 90s and early 2000s especially, and the various regulators at the Federal Reserve and the SEC were all asleep at the wheel, intoxicated by free-market ideology, and so people were out. Banks were making loans they shouldn't have. The various firms got more leveraged on Wall Street, and the government should have done something about that. And we saw this housing bubble develop, and people just didn't intervene. And then once that bubble burst, various people that were over-leveraged, they had to spend less. And then the other people, like the creditors and so forth, that in theory should have been spending more, weren't also, just because they were so shocked by what just happened. Mm-hmm. And so that's, I think, the general story. He might change some of the details, but I think that's what he would say as far as why did people all of a sudden start spending so much less in 2008, let's say, but now given that they are spending less, then he's saying look at there's nothing wrong with the real economy. We still have the same amount of tractors and farmland and computer programmers and surgeons that we did in 2006. It's just people collectively aren't spending enough money to keep them all employed right now, and so that's why the government has to come in and spend more. So I think in terms of the plausibility, the one dimension on which the Keynesians, I think, appeal to the average person more than the Austrians is it does seem like in a recession, look, if there's a bunch of people that are unemployed and just sitting on the sidelines, surely it's only going to help if we can get them doing something. And so if the government comes along and just starts spending money for them to go build bridges or fill potholes, well, surely, that's going to help because now they're doing something instead of sitting there doing nothing. And in the Austrian view, though, you can't just have workers willy-nilly going and doing things that politicians dream up, that the way to integrate them into the economy is to have the market do it, and during a recession period, there's that necessary reallocation of workers, that workers were doing things they shouldn't have been doing during the boom period, and now it takes time for them to get reintegrated back into areas where they should be. And so, but
and
I
to
think
that
for a lot
point,
of
we just did a show with Walter Block talking about jobs for our listeners. What Bob's talking about is we don't want, if we could get people back employed digging ditches, if those aren't useful jobs, we probably really don't want them. So there's an interview that we've done with Walter Block about job creation, why we really want jobs, and even if we could get everyone employed, pulling weeds, these aren't exactly the kind of jobs that we want. And we are coming close to the end of our second segment. We will be back with Dr. Robert Murphy talking about Austrian business cycle theory and his debate with Paul Krugman. Stay with us on RadioFreeMarket.com. We'll be right back. Hello, America. We are back on RadioFreeMarket.com with Dr. Robert Murphy. So we've talked a little bit about the Keynesian view. If our listeners wanted to do some self-study and some more research into the Keynesian position, where would you recommend they go to find good Keynesian literature?
Well, as far as just their daily checking blogs and things, I would go to Paul Krugman's blog. I mean, that's why I read him, because I think he's a good writer, and he also obviously knows the Keynesian theory pretty well, and he can take it and it's ironic, like any given thing where in my mind, that's just stunning confirmation of the Austrian approach. He'll take the same empirical data and somehow integrate it and in my mind spin the facts so that this is just what the Keynesians have been saying all along. So his blog is at the New York Times. People just Google Paul Krugman NYT blog. You'll be able to find that. Another guy is Brad DeLong, and DeLong is spelled D-E-L-O-N-G. He's a guy out in California, a professor that's also a prominent Keynesian, who's also a pretty clever writer. And so those are two of the more famous Keynesian bloggers, if you will, but they're also actual academics and respected in the mainstream. But then even guys like Greg Mankiw, so it's not like there's this guys in the corner that are Keynesian and these guys over here in the corner that are Austrian. I mean, the general Keynesian mindset actually pervades most of the profession. It's just, Krugman is particularly out there in terms of like his advocacy of this stuff. But I mean, even like Greg Mankiw and other guys like that who are supposed to be like more moderate and even free market in some areas, they agree that this is a problem of there's not enough spending going on. It's just an issue of how do you boost the spending in their mind.
Mm-hmm. And that is very true. That the Keynesian mindset is very pervasive, because most people, I think, would, without even giving a second thought, say, yeah, of course the boom bust cycle is an inherent feature of capitalism in the free market. Of course, that's just how it goes, right? And we hopefully, when we get into the Austrian business cycle theory, our listeners will see that the boom bust cycle is not part of the free market. It is created by government intervention. So
right,
sorry, what?
One more thing on that, and just to show you what I mean, that when even just the financial press, the reporters don't think that they're taking sides in an ideological debate. They just think they're reporting the basic facts. They'll say things like, consumer spending was up last month, so that bodes well for the recovery. Or they say, consumers are using their credit cards again, so that's a good sign. or going into the holiday season, they'll be wringing their hands saying, "Oh, we really hope consumers spend enough this year to help out the retailers, or else the recession is going to continue." So it's this whole mentality of people just need to go to the mall and buy stuff, and that's what means a healthy economy. That's a very Keynesian analysis, even though they don't realize it.
Yeah, that's true. Every time you hear a piece of news that consumer spending is up, retail spending is up, as if this is supposed to be one of the markers for good health in the economy. So we've got the Keynesian explanation. Now let's hear the Austrian explanation for the boom-bust cycle. And to our listeners, this is a very important topic that I encourage you to go back and listen to several times, but we'll try to explain it as best as we can so you can get it the first time. So Bob, we've talked in other shows, and you mentioned it earlier about the Federal Reserve and how it creates money out of thin air. We say printing money, but even in the computer, technically it's still printing money, just creating it out of thin air. Is this in fact true? Does that actually happen? Does the Federal Reserve just conjure up money out of nothing?
Right, exactly. And a lot of people, when they hear that, they think that you're exaggerating, that it's not quite like. But really, when Ben Bernanke, this quantitative easing second round, the QE2 as they call it, when he says, "Oh, we're going to buy $600 billion of government securities," where does he get the money to do that? Well, he just writes checks. Technically, the New York Federal Reserve Bank buys bonds held by people in the private sector, and it just writes checks drawn the Federal Reserve and hands them over, and then gets the bonds in return. And then those people go and deposit those checks in their banks, and now their checking account balance goes up by the amount of the check. But the Federal Reserve, it's not that it has a stockpile of money somewhere that it draws down when it wants to buy stuff. The Federal Reserve has an infinite amount of dollars because it just writes checks on itself, and they automatically clear. Like the Fed can't bounce a check because by definition, when the Fed writes a check and gives someone a deposit with the Fed, that's legal tender. So yes, when the Federal Reserve buys assets and expands its balance sheet, it just creates those reserves or that check out of thin air. Okay, so that's what I want to make sure our listeners really understand. It is a fact the Federal Reserve actually creates money out of nothing. That is no exaggeration. So keep that in mind, folks. So can you just give us a very short overview of the Austrian theory of the boom-bust cycle, and then we'll break it down with some simple allegories and metaphors. Sure. So the bird's eye view of the Austrian business cycle theory is that market prices help people communicate with each other. They help coordinate producers using resources to satisfy what the consumers want. And a very important price is the interest rate. And the interest rate helps sort of regulate activities over time to balance how much households are saving with how much investment businesses do. And when the Federal Reserve prints more money and dumps it in the credit market, that pushes down interest rates below what they should be, and so that price is now wrong. That's a false signal that goes out. And so businesses start investing too much. They start investing in projects that are too long. There's not enough total savings to go around. And so that gives a temporary period of euphoria, this false prosperity that we know is a boom period.
Okay, Bob, I'm going to interrupt you real quick. We're coming to the end of this segment, but we will come back to that very important point about savings and the interest rate. Stay with us on RadioFreeMarket.com. We'll be right back.